KOSPI falls 4.46%, capex doubts, and rising oil pressure. SK Hynix. Welcome to the Explainer. So, the South Korean market just put us through an absolutely massive two-day whiplash. We're talking extreme data overrides, total algorithm chaos, and some seriously aggressive capital flows. Let's just dive right in and deconstruct this whole shock and awe sequence step by step. All right, so the trigger was pulled on July 20th. The KOSPI plunged 4.46% in a single brutal trading session. And, this wasn't just some localized sell-off in a couple of sectors. It was total systemic fear. Out of the 943 constituents in the index, a staggering 799 stocks bled red. But then, 24 hours later, a totally violent reversal. On July 21st, the KSPI suddenly rocketed back up 3.56%. This was a highly targeted, super aggressive capital injection, and it completely blindsided retail investors. The sheer scale of the daily price action is honestly wild to see. You had this steep, terrifying drop that was basically erased immediately by a massive wave of buying. But to really understand how we got this structural whiplash, we've got to look at the twin macro fears that initially broke the market on the 20th. Okay, macro fear number one, AI efficiency. So news broke that Moonshot AI's new model achieved top-tier performance but used significantly less computing power. And the market basically panicked. The thinking was, if AI models become hyper-efficient, hyperscalers might stop buying endless racks of GPUs. That was a direct threat to the demand for AI server memory. Then we have macro fear number two, which is all about geopolitics. Rising US-Iran tensions near the Strait of Hormuz sent oil prices spiking. And we all know higher oil means higher inflation, which quickly drove up Korean government bond yields. In the financial world, those higher yields act a lot like gravity on tech stocks, just compressing valuations from every single side. But right when the panic peaked, hard data stepped in and completely obliterated the bearish narrative. At exactly 9 a.m. on the 21st, South Korea released its preliminary July trade data, and that whole AI slowdown story instantly crushed by a single metric. Semiconductor exports had literally just surged by 180.6% year over year. And the sheer volume of that surge was staggering. In just the first 20 days of the month, semiconductor exports hit $22.1 billion. Suddenly, chips were making up over 40% of all South Korean exports. The math completely proved those AI infrastructure fears false. Naturally, this hard data triggered an immediate rescue mission. Institutional and foreign money aggressively flooded back into the market, and they aimed straight for the top. Foreign investors alone scooped up over 500 billion won worth of Samsung electronics. They were actually liquidating other positions just to fund this massive, super targeted buy. And that buying frenzy rapidly spread to SK Hynix. Remember that fear about AI memory demand drying up? Poof, vanished. Institutions poured 682 billion won into SK Hynix. They easily absorbed a huge wave of foreign selling on that specific ticker, all just to lock down the memory giants. It's fascinating because the data perfectly illustrates this extreme market concentration. Institutional buyers dumped 1.37 trillion won into the market overall, but nearly 84% of it was concentrated in just those two tech giants. The entire rest of the market was pretty much left fighting for scraps. Now, this intense stock buying spilled directly over into KOSPI 200 futures. Surging futures triggered what are called non-arbitrage program trades. Basically, these are algorithms blindly buying baskets of stocks without hedging. These relentless algorithms alone injected nearly 848 billion won into the market, which added pure, unhedged rocket fuel to the upside. The upward momentum was so violent that the market's literal circuit breakers had to step in. Right at 12:41 p.m., KOSPI 200 futures surged 5% and held there for a full minute. The exchange had no choice but to trigger a buy sidecar, a 5-minute pause on program buying just to cool things down. Talk about a complete 180-degree reversal from the previous day's panic, right? Let's look under the hood for a second at why this accelerated so incredibly fast. It was essentially an algorithmic positive feedback loop. Trust accounts managing leveraged ETFs were mathematically forced to buy in. See, as the index rises, they must buy more futures and stocks right before the close just to maintain their leverage ratios. So this blind buying just pushes prices even higher. But we have to ask, was this mechanical bounce actually justified fundamentally? Well, yes. A really timely report showed both tech giants were severely oversold. Samsung and SK Hynix actually saw their forward price-to-earnings ratios drop below 5. Keep in mind, their historical average is around 10. They were trading at a massive discount, even if the earnings were magically cut in half. And because these two companies essentially are the index in many ways, their discounted valuations dragged the entire KOSPI down to a forward PE of 5.55. To put that wild number in perspective for you, that is actually cheaper than the absolute depths of the 2008 global financial crisis. Now, let's expose the hidden signals in the order flow, because the divergence here is absolutely stunning. While the smart money, the institutions, rode the data-driven rebound by injecting 1.37 trillion won, individual retail investors completely capitulated. They panicked and sold off a massive 1.64 trillion won. It is a perfectly agonizing timeline for retail traders. They tried to catch the falling knife, buying heavily on the 16th and the 20th drops. But the exact moment the market sharply reversed and rocketed upward on the 21st, they panic sold to trim their losses. They literally dumped their bags right as the institutional rescue operation took off. And that brings us to the harsh reality of the session. Yes, the headline index jumped 3.56%, but market breadth was incredibly weak under the surface. The heavy buying was concentrated almost entirely in the semiconductor sector, while 380 stocks still declined. So this wasn't some broad economic recovery. It was a highly targeted chip rescue. So we are left with the ultimate question. Is the Korean market finally pricing in fundamental reality, or is this just another fragile mechanical ETF bounce waiting to snap back? The hard data won today for sure, but the market structure remains highly volatile. If you'd like to receive this kind of news on the closing of Asian stock markets before the New York stock market even opens, please make sure to subscribe. See you next time.